$1 trillion. That is the combined capital expenditure the world's 5 largest hyperscalers are expected to deploy on AI infrastructure across 2025 and 2026, according to the BIS Annual Economic Report published June 28, 2026. And on June 28, 2026, the institution that coordinates the world's central banks published a formal warning. That number may not be only a growth story. It may also be a systemic risk. The Bank for International Settlements is not known for alarm. That is exactly why this warning matters. For most of the past 3 years, the AI Capex story has been told exclusively as a growth narrative. Hyperscalers spend, chip suppliers benefit, equity markets rally. The circuit is clean, the direction obvious, the logic internally consistent at every node. What changed on June 28, 2026 is not the spending figure itself, that was already visible from Q1 earnings calls, but the institution doing the warning. The Bank for International Settlements published its annual economic report and placed the sustainability of AI-related investment alongside persistent inflation, sovereign debt fragility, and financial system vulnerability as one of 4 interlocking pressure points threatening global economic stability. The BIS Annual Economic Report is the closest instrument central banking has to a full system stress diagnostic. It does not name individual risks casually. When it places AI capital spending alongside sovereign debt fragility, persistent inflation, and financial system vulnerability as one of 4 interlocking threats to global stability, that placement is deliberate. And the consequences of that naming extend well beyond the report itself. The structural concern is not simply that companies are spending more than ever, it is that the spending cycle is now detached from the cash flows that historically governed how much technology companies could commit. According to the BIS Bulletin number 120 published March 2026, capital intensity for the 5 major hyperscalers, Amazon, Alphabet, Microsoft, Meta, and Oracle, has reached between 45 and 57% of revenue. Ratios the BIS described as previously unthinkable for technology firms. These are levels that resemble utility or industrial infrastructure companies, not platforms built on marginal cost economics. When capital intensity exceeds internal cash generation at this scale, the financing gap flows directly into debt markets, and increasingly into debt structures that regulators cannot fully see. The BIS March 2026 quarterly review, published March 16th, had already mapped the structural problem. Hyperscalers are financing AI infrastructure through off-balance sheet vehicles, private credit funds, and what the BIS explicitly termed shadow borrowing, obligations economically equivalent to debt that simply do not appear on corporate balance sheets in conventional form. Private credit funds originated over $40 billion in loans to AI-related companies in 2025, compared with roughly $3 billion in 2010, according to BIS Bulletin number 120. That is a structural transformation in how the technology sector accesses capital, driven in 3 years at a pace that took other sectors decades. Why does financing architecture matter as much as the raw spending numbers? Because leverage does not disappear by being out of sight. 3 months after the quarterly review, the June Annual Economic Report escalated the framing. Disappointing returns, the BIS stated, may trigger a sudden tightening of financing, turning the capital expenditure boom into a lasting investment depression, and potentially causing chain reactions through global financial conditions. The phrase lasting investment depression is not editorial language. It is historical taxonomy, drawn from a framework the BIS built by studying how prior technology booms ended. The BIS reaches back across 4 technology cycles to make this point: canal mania in the 1830s, British railway mania in the 1840s, the electrification boom of the late 1920s, the dot-com surge of the late 1990s. Each one was built on a genuine technological breakthrough. Each one attracted capital that outran what commercial returns could justify in the near term. And each one ended not with a clean slowdown, but with an investment reversal that pulled the broader economy down with it. The BIS is not saying AI must end the same way. It is saying the structural signature is familiar. The Capex commitments clarify the stakes. According to Q1 2026 earnings calls reported by CNBC on April 30, 2026, Alphabet guided to $185 billion in annual capital expenditure for 2026, Amazon to $200 billion, Microsoft toward $190 billion, and Meta to $135 billion. Wall Street analysts at Evercore and Bank of America subsequently placed 2027 aggregate hyperscaler Capex above $1 trillion for a single calendar year. The BIS annual economic report's reference to combined 2025 and 2026 spending exceeding $1 trillion is a confirmed accounting of commitments already made. The BIS quarterly review identified the precise mechanics of how that financing is structured. Special purpose vehicles, joint ventures, and private credit arrangements move leverage off corporate balance sheets while preserving the economic obligation. Banks provide funding lines to these vehicles, creating what the BIS described as new shock transmission channels, pathways through which refinancing pressures at the vehicle level, procyclical shifts in private credit appetite, or the triggering of embedded guarantees could transmit stress rapidly across financial counterparties. What happens when those guarantees activate simultaneously across multiple vehicles in a market correction? Zhang Tao, BIS chief representative for Asia and the Pacific, addressed exactly that question in a June 28, 2026 interview with the South China Morning Post. The interconnectedness of the financial system, he stated, could mean the speed of any correction would be much faster than in previous banking crisis episodes. The system would not simply slow down. It would unwind, and the unwinding would be visible to regulators only after it had already begun. The annual economic report also identified circular financing as a compounding structural risk. Hyperscalers are taking equity stakes in AI laboratories in exchange for cloud purchase commitments, while those same laboratories depend on hyperscaler infrastructure for their research and commercial operations. Revenue from one side of the arrangement funds access to the other. The BIS modeled financial unwind scenarios, and the mechanism involved partial dissolution of these cross-firm partnerships and distressed debt sales. Cascades, not orderly corrections, and not the kind that conventional balance sheet analysis would anticipate. That is the core problem. The risk is not invisible. It is structured to be difficult to see until it starts moving. None of this means the bears are right and the bulls are wrong. The revenue data is real, and the BIS says so directly. At approximately 1% of U.S. GDP, the BIS Bulletin number 120 noted, AI-related investment is currently similar in scale to the U.S. shale boom of the mid-2010s and roughly half the size of the IT investment surge during the dot-com boom, a period when concerns about overinvestment proved premature in the long run, even as they were partially validated in the short run. Cloud revenue is real. Alphabet's cloud segment grew 63% year-over-year in Q1 2026, per CNBC's April 30th earnings coverage, and Azure AI revenue was tracking at a $37 billion annualized run rate, up 123% year-over-year. The BIS explicitly acknowledged in its annual economic report that AI has so far provided important impetus to global growth and could significantly boost productivity over the next decade. It does not deny the technology's potential. What it contests is whether the current financing architecture is correctly priced for any scenario where revenue growth slows before the Capex cycle completes, and whether the opacity of shadow borrowing means that stress, when it arrives faster than central banks can effectively respond. The historical record the BIS invokes does not resolve that uncertainty comfortably. Fortune, on June 2, 2026, published analysis drawing direct parallels to the railroad companies of the early 1870s. The most exposed firms in that cycle were not the fraudulent ones, but the ones that believed their own projections and continued committing capital even as the returns window was already narrowing. Is the current AI Capex cycle structurally different enough to avoid that outcome? The BIS annual economic report does not claim so. It identifies the same structural signature and leaves the timing question open. BIS General Manager Pablo Hernandez de Cos told reporters on June 28, 2026, that the institution's message was one of urgency, because debt levels are high and those debt levels are being financed through non-bank financial intermediaries. Frank Smets, acting head of the BIS Monetary and Economic Department, added that the new fiscal financial stability nexus may mean more frequent and sharper drops in sovereign bond values, with rapid tightening effects on broader financial conditions. Two pressure systems. each capable of tightening global financial conditions on its own, each more dangerous if they arrive together. The BIS cannot time that scenario. What it has done is publish the map before the terrain shifts underneath policymakers, investors, and the companies building the infrastructure itself. What Smets was describing is a contagion pathway that runs far beyond Silicon Valley balance sheets. AI Capex stress moves through private credit vehicles, through hedge fund positions in sovereign bond markets, through the equity valuations that support household consumption across advanced economies simultaneously. The BIS mapped the chain from technology infrastructure to financial stability in a single analytical framework. Is that chain strong enough to contain the stress if both AI returns disappoint and energy inflation re-accelerates simultaneously? That is precisely the scenario the report was designed to flag. The annual economic report was published the same day the BIS identified a compounding pressure: inflationary dynamics from the February 2026 closure of the Strait of Hormuz that have not yet fully materialized in consumer prices. If central banks in the United States, the Eurozone, and the United Kingdom are forced to raise rates into an environment where AI financing vehicles are already under stress, the interaction of those two forces is precisely the scenario the fiscal financial stability nexus concept was built to describe. Two macro pressures arriving together, each capable of tightening financial conditions independently, each amplified by the other. The BIS cannot predict the timing of that interaction. What it has done on June 28, 2026, is publish the framework for what the consequences look like and issue a formal call for policymakers to act before the pressures compound further. That call came not in the executive summary, but in a direct address to reporters at the press conference. That is deliberate institutional communication of a kind markets have historically been slow to price. The institution that coordinates the world's central banks named the AI Capex cycle a macro-financial risk on June 28, 2026. That is the signal markets were still processing, while parsing revenue lines in Q1 earnings calls. Somewhere inside $1 trillion of committed capital and off-balance sheet obligations that regulators are still mapping. The question is no longer whether AI is reshaping the global economy. The question is whether the financial architecture supporting that transformation was built to absorb a correction, or to accelerate one. The BIS published its framework on June 28th. Markets are still deciding whether to read it seriously. Facts over fear.